Rick Bensignor is here. He is a chief market strategist with Merlin Securities. Jerry Webman is the chief economist at OppenheimerFunds. Thank you, gentlemen, for joining us. Glad to have you both with me here in Pim's fine shoes.
Right.
So I'm going to start.
Better shoes. I don't think Tim would wear those shoes. They're pretty cool, but I don't think that would be Tim's cup of
It's
tea.
not really his style.
Right.
We just heard Julie and Deborah talk about this optimism, and it seems somewhat foolhardy. I probably shouldn't say that, Rick, but I have a feeling you might.
Well, the optimism so far is a one-day event after the S&P fell 7 days in a row. So finally we get a little bounce in the market off of some good news. But my guess is the bounce was slightly exaggerated, mostly because as the market wound down last week, you saw kind of just people dumping out of stocks that had most likely bought perhaps a full 100 S&P points higher, and the pain of just holding them got too great, and they finally sold them out.
And Julie said, I mean, we've seen this movie before. I mean, it doesn't mean that it's not a reason to buy, but it seems like anyone who's been watching the European crisis knows it's not over. It's at least a year from being over.
Look, we have such headline risk now every day. You can imagine if you went home short last Friday and you come in and you see the S&P futures up 30, 35 points this morning. I mean, it's enough to give you conniptions. I think it's very hard to truly have conviction in the marketplace now for anything longer than short-term trading.
And Jerry, I mean, how do you see this as an economist? I mean, how many points off of our GDP can the situation in Europe take?
You know, you can sit and produce fancy big models that would say because we export so much. And I don't think that's really the issue. That's not why the market is so volatile here. The market is so volatile because of fear, because there's the fear that there will be some sort of lockup in the financial system that means fundamental values, whatever we kind of say, let's go and do the spreadsheets and calculate the numbers, that isn't going to matter in these short-term swings in the market. So I think we can look at those numbers and say, well, we export a little bit to the U.S., to Europe, it's going to hurt those export markets. But what we're really afraid of is this multifaceted game of chicken that Europeans are playing with each other, that somebody drives off the cliff.
And so by that, you mean some kind of event that leads to a bankruptcy of a major institution or something that would be a shock to the U.S. economy?
Something that would be a shock to the global economy and cause, listen, you know, there's all this talk, which is completely misplaced, about Weimar and printing money. Actually, Weimar was brought down by a failure to print money, not by printing money. So that fear of inflation hangs in Europe. So that's all there's this fear, but there does need to be some fiscal discipline. If I'm a German taxpayer, I don't want to continue to pay money to see somebody else get benefits I'm not getting. So there's need for structural reform, but it's a question of can that structural reform get put in place before institutions like the ECB do what we know they'll do eventually.
Speaking of discipline, we can't say that it's all Europe's fault right now, right? We had Fitch come out in the last 15 minutes reiterating the U.S.'s AAA rating, but revising the outlook to negative. Now, we should say, I mean, this wasn't a surprise, right?
No,
Fitch said it was going to do this if the super committee failed to make progress. It failed to make progress, so now here we are.
That's the issue, is the super committee not being able to make any progress at all. Politics are as heightened as they've ever been, both in Europe.
You mean?
Yes,
yeah.
And both here. And as much as you talk about having a non-bipartisan, or the attempt to have a non-bipartisan Congress, when it comes down to it, these guys are not doing anything to promote legislation to getting forward. And I think the American public is looking towards government now to really step up and kind of show, hey, we can work together and make a difference in an economy that's really struggling.
At least the Europeans have been willing to shake things up a little bit on the political front, sometimes because they've been forced to do it, but at least they have been willing to say, all right, let's get some reform in process. Here we are, what one political scientist has called a dysfunctional equilibrium. That we're stuck. We're stuck.
With only one language and in theory 2 parties, I guess we should be doing better. Sit tight, gentlemen, if you don't mind. Continuing the conversation, we were talking about Fitch's non-surprise outlook, taking the U.S. to negative, reaffirming the AAA. So, Rick, you said it too. Look, it's not a surprise. It's not going to change anything in the near term for market sentiment. Jerry, what would this mean? I mean, what happens if Fitch does make the move that feels like it's one step closer now? What does that mean for our economy?
Remember what happened when S&P actually downgraded us? The bonds rallied. I think as long as you have the situation where where the U.S. Treasury bond is the world's perceived safe haven, it's not going to have a big effect on the market. The problem with counting on that sort of situation is that, bonds are loved in the market until the moment when they're not. You saw a little taste of that with Germany last week when that auction didn't go off as well as they expected. Bunds were wonderful until they weren't. And of course, they were at 2% or something. It's not like, they're not worth Italy. But it's a good indication of how fickle the bond market and how tough the bond vigilantes can really be when they get going.
Right.
Of course, that was dangerous as well, too, because people were extrapolating this idea, wow, if investors aren't even interested in the strongest European state, what does that mean for the weaker players?
Well, and of course, they are interested. They're just interested at a little higher interest rate and not a desperately higher interest rate. It is the perception. The only reason anybody's willing to buy peripheral debt now is the perception that there will be some combination of IMF and ECB, and probably with German taxpayers standing behind it. Somebody's eventually going to fix this, but there have to be some major structural reforms first. That's the tough part.
I think the question also comes down to when does that occur? Because in a portfolio manager's life, you basically have January 1st through December 31st, and that's all he cares about. The clock resets the next January 1st, and he's on a time frame of what can I do and what can I produce in a 12-month time frame.
Must be our OppenheimerFunds portfolio managers have a 5-year horizon at least.
Yes,
but
they get paid annually.
They get paid
right, so
not necessarily. But you make the right point that there is a feeling among portfolio managers that we're as good as our last good idea, and we get punished a lot for making bad guesses. Nobody wants to make a bad guess on, or let's say a bad guess, to have done the analysis and lead to a bad conclusion on this kind of debt. It's too painful.
Well, it's also, look, in behavioral economics, you have cognitive dissonance, which in a portfolio manager's mind, to explain what this is, it's kind of the internal battle between doing what's necessarily right fiduciarily for my clients, but also really realizing I have kids to put through school and that side, and I have to get myself paid too. And there's always this internal battle in the mind on how to do this. The marketplace would always think the PM will go towards the right side of doing what's right for his clients, and I'm not saying they don't, but at the same time,
math and not emotion.
They're human beings, and human beings typically make irrational, bad decisions.
Well, the other way in which exactly that same phenomenon shows up is such a smart guy as me made that decision last week. It must have been a great decision. I'm going to resist the evidence that says I should back out of that. An even worse problem. An even worse.
If you're going to be a good trader, you have to first and foremost be humble.
Anytime I put out a major recommendation, I'm always assuming I'm wrong. I come from the stance of, if I'm wrong, how do I play this? How do I protect my risk? Where is this call wrong? And I just assume, even though obviously if I'm putting my name and reputation behind it, I think what I'm doing is right, but I'm always measuring it from the risk side of what if I'm wrong.
So, Rick, speaking of right and wrong, where do we go from here, right? That's an obnoxious turn on my part, but for the S&P 500, I mean, we're down 5% year to date. Where do we finish the year?
Well, I think this morning in our piece, we wrote that we think we get above 1,200, possibly push towards 1,236. Just in kind of round numbers and looking at the scope of things, the 200-day moving average is quite flat. It's up in the 1250s. It's come down from the 1280s where the market rejected it when we hit it a month and a half ago. And my guess is it's going to act somewhat as a magnet. Doesn't mean we have to close right near there, but I would think you're probably going to be a few percent on either side, and the likelihood is not on the upside of it. Hard to figure out right now what would push us back up through kind of where we just sold off from. So my guess is round numbers, 1,200, 1,250, we end the year.
All right. Well, thank you both very much for the conversation. I'm glad I got to have it and Pim didn't. I'll have to brag when I see him next. Thank you very much, Rick Bensignor, Jerry Webman, joining me here.